Well, I think it's gonna be challenging because we are now only in the phase of dealing with the health issues. We haven't started in most of our country our recovery strategy, and as you know, we don't have the same toolbox of basically money printing. We don't have a reserve currency as Africa, so we cannot use the different tools of liquidity to inundate our markets for recovery. So we have a huge problem to deal with in terms of recovery. So many of our SMEs and banks will struggle. So we hope that in the next months, African countries will push for schemes to get an infusion of close to $100 billion, which is what more or less we need in order to start the recovery process of our economies.
Right. So Paulo is coming from a monetary policy point of view. How about from a human capital point of view? Didier, do you see the worst of situations that's impacting unemployment, bankers, people, professionals? What's your take on this from the recruitment side?
Well, indeed, I think we have not reached the top of the wave because a lot of companies are closing down, and according to some figures we get from the African Economic Commission, they're planning to have like 30 million jobs lost due of the COVID. So so far we're not very optimistic about the near future. And as Paulo was saying, you don't have strong financial measures to support SMEs. So
right. And how about Charles, from the NA point of view, do you see because of the challenges and pressures that are happening because of COVID, right? And it will only get worse before it gets better, as alluded by the two panelists, right? Do you think that you're going to see more increasingly more M&A activities amongst banks, more consolidation happening that will precipitate all these what do you call it, challenges, or rather the solutions over these challenges?
Yeah, I mean, the beauty of history is that when large crises like this occur, there is always a time lag before it fully hits the African continent. If I only look at the 2018-29 crisis, the bulk of the impact on the banking industry was felt between 2020 and 2021. And this is where we saw the peak of non-performing loans occurring. And that typically triggered a wave of consolidation, which, for instance, in Nigeria, pushed a lot of banks to literally come together. I believe this crisis being of a level of severity which is much higher, in a couple of years, we should see this, going forward quite fast. And therefore, we can expect that a new wave of consolidation might actually happen, essentially because small banks will quite likely suffer from this crisis, probably more than any other before.
Fantastic preliminary inputs, guys. Now we are about 9 minutes past the 7:30, right? So PM in Singapore and Malaysian time. So let me just start the session proper. Thank you for your initial sharing. Dear ladies and gentlemen, welcome to our first episode of a series of webinar organized by New African Capital Partners, right? As well as MyFinB, who are basically working together to bring about a series of banking and finance transformation program through the use of AI in the context of COVID-19 pandemic. So I have with me very experienced people, they are very much involved in the banking and finance sector and involved in international organizations prior to their current practice and ventures. So they bring about a lot of expertise, as you can see in the initial screening and flashing of their profile. So Didier specializes in human capital and certainly has access to a lot of CEO, C-suite level of management across the African continent. While Paulo is no stranger to any form of SME development, banking and finance, and economic development activities across Africa. And while Charles is a very famous senior banker who's from the Fortune 500 or at least the MNC institutions that are involved in banking and finance too. So without much further ado, I will start off by giving some background or context about my presentation, which is about banking on AI, impact of AI on the African banking sector and beyond. Okay. So my presentation will cover a few parts. Okay, one is the current state of play. Part 2 will be about acquiring customers. Part 3 about credit approval. Part 4 is about monitoring risks through the use of AI. So what I do is I basically provide the context of what banks all around the world are essentially prioritizing in terms of AI adoption first. And here is a research piece by World Economic Forum that looks at the statistical adoption of AI across different facets of banking. For example, you can see there are 5 dimensions here: customer service, client acquisition, risk management, process re-engineering, automation, as well as generation of new leads and for purposes of generating revenue through new products and processes. You can see that, you can see that there are different priorities. These are all important, but customer service or customer engagement seems to be very much implemented by institutions all over the world, and followed by client acquisition. Getting quality customers is very important for them. And while getting customers are important, managing the risks associated with the customers are just as important, trailing by a little bit behind the priority of 68% in terms of implementation. And you can see that there are increasing emphasis on generation of new revenue potential, looking for new areas of sales, new source of growth at 38%, okay, which is currently implementing, followed by risk management, as well as process re-engineering, reconstructing, remodeling the banking business. So you can see that banks are basically looking at these 5 dimensions as a key source of productivity and business innovation. And again, within the bank segment, the deposits and lending seems to be a high priority, okay, in terms of the financial services industry. Generation of new revenue potential, again, process re-engineering and customer service, as well as risk management. These are some of the key aspects within the banking sector that focuses on the customer deposit and customer lending, while other areas like payments, market infrastructure, and investment management in particular, which is particularly looking at new revenue potential, new areas for investment. And the next current state of play will reference to McKinsey that looks at the how the core business of the institution can be extended further into 2 other levels. Okay, so you can see within the inner core of the banking sector, there's a credit, insurance, investments, cash management, and financing. Right, these are the core banking activities that can be that have a spillover effect on what sort of discounts you want to give to your customers, how to manage the taxes, giving tax advice to the businesses, your clients, in regard to your financing for expansion or M&A, whatnot, right? Suddenly they team up with accounting software to create a seamless experience from accounting to banking activities, right? And banks have also teamed up with training education providers to provide financial education, especially in financial literacy and so on, right? And outside of it, therein lies different what you call horizontal non-banking ancillary services like health services, facilities management, stock management, mobility services, and IoT related matters like home services. So you can see that the upstream and downstream and the B2C and B2B model is being applied for the bank. And it's no longer a situation where the bank resorts to just traditional transaction, traditional banking and lending kind of activities. There is a spillover effects, and the innovative banks will be the ones that will provide an integrated, seamless activities across these services, right, using technology. And taking a leaf or some research materials from Deloitte, within the banking value chain, you can see that the frontline, mid office, and the back office is going through what you call transformational change. So from the upstream and the downstream, they're looking at people management, they're looking at risk management, operations, right? And they are basically adopting AI across each of these value chain. So not all banks are into this bandwagon, as you can see, right? Only X% or 40% are still focusing on customer experience. Meanwhile, there are other aspects like risk management that is falling a little bit behind. This is how they use AI to basically profile customers. They use AI to identify investment opportunities. They use AI to do credit scoring, right? They use AI to do AML, KYC activities, fraud monitoring, and so on. And they also use AI to basically deal with cybersecurity and predicting performance of management and people and HR. So these are all the types of technologies, or rather the types of activities within the banking value chain that are currently being absorbed, okay, by the banks through the use of AI-based technology. Now, it's easy to mention AI from beginning to the end, right? But I think to get the things rolling, right, we must first define what is AI, right? But to define it, you must identify by identifying what it's not, right? So in terms of definition of AI, what it is not is basically, it is not pretty charts. It is not data visualization. It's not giving you a nice picture, nice design, nice graphics about where you stand, your trend lines and all that. That's not AI. That's called business intelligence, right? And then the second one is ratios and numbers. It is not just matrix on a dashboard. It's not, AI is not about ratios and numbers. It is not about mathematical solutions and displaying on a nice graphics on a dashboard. And AI is certainly not transactional query-based chatbots that just ask you about when does the branch open, when does it close, and so on. Okay, AI is a little bit more complicated than that, right, and more sophisticated than that. So basically, it entails looking at your structured and unstructured data, like P&L statement from a banking perspective. You look at P&L, cash flow, bank statements, balance sheets, ledgers. Then you look at all the news that's been happening, website, annual reports, social media, and news, right? Gather all these points together. What the typically AI engine goes through is that it goes through 5 levels of analytical human decision, analytical human based decisioning, which is it has a descriptive component, it has a diagnostic component, it has the predictive component and prescribing, as well as auto monitoring, telling you what happened, why did it happen, what can happen in the future, what needs to be done, and what are the red flags that need to be looked at in the next 6 to 8 months. So it comes with all these analyses, and it mimics the way humans make decisions. And this is typically what AI is all about and can be applied into the value chain that the Deloitte research has shown us. So let me touch on 3 simple things. One is about acquiring customers, right? So AI can be used to acquire customers, such as to profile them, to predict their needs, and to come up with financing and asset protection solutions. So what does it mean? Let's say in the context of financial planning, right? When it comes to financial planning, you look at a consumer financing or consumer financial planning or financial planning or financial advisory. You basically provide, you get the inputs of a person or family, and the machine can basically identify the kind of spending that you have, the personality that you exude, the economic outlook of a country, right? And then it looks at the dynamics of your financial positioning, the industry outlook, what is going to affect you financially, personally, individually, as a family. What are the things that will impact you in the next 6 months because of COVID? How to expand your asset, how to reduce your expenses, and where are the areas that you need to identify to improve your financial positioning. So what it does is AI like this is able to connect your income, expenses, asset, and liability, and generate a deep analysis in terms of your financial health and what needs to be done with regards to improving your net worth, how to expand your wealth, how to buy another property, how to pay off old debts by getting new debts. So this is an example of how banks can acquire customer by providing value-add services, okay, as not as a fee, not as a premium service, but as a value-add services that can be, generating a lot of leads for you and give them value-add before they transact with you, whether to buy insurance products or whether to get into a new financing scheme to buy new properties. So in order to entice them to come, you give them value-added services. So the second strategy is on customer experience. So this is about, it's in the context of SME. How can you value add beyond, again, transaction focus, how to become trusted advisor, and how to know their business needs and connect with their marketplace. So again, let's say you're targeting business owners, banks can bring themselves closer to the SMEs by giving them value-added services for free, right? And they can basically immediately get some form of financial health check for their business. Prior to that, you saw more of individual personal financing, right? So this is more of enterprise financing. So here you can see a benchmark their health, where their gaps are, right? Where are the challenges, and the system, basically the AI basically analyzes your financial health and tells you what needs to be done to improve it, right? So they curate articles, multimedia, curate all this information to become like a value-added service for the client. So the customer basically feels so good being taken care of the business owner by the banks. And that the banks are not just after their money, but the banks are truly concerned about their business health, about their business strategies, right? And all these things become a very important, what you call value-added services. Last but not least is the risk management part. So how do you recognize risk at the onset? How do you predict future trends of corporates? And how do you monitor and highlight the issues that are likely to happen? So again, for corporates, right, as opposed to SMEs and personal finance, corporates can be given a board of directors reports, detailed analysis about their company, about their risk levels, right, about planning their financial needs and so on, and what are the key areas that they need help in, okay, and identify where are the areas that they can improve on. So at the same time, the risk managers will basically spend time looking at red flags, looking at, okay, before I lend you, I know my risk about this company. But after I lend you, I still need to monitor my risk to you because my exposure to you is very huge, right? So as a bank, you are more concerned about what happens when you lend, whether you can collect the money, whether the effects of COVID can basically worsen the balance sheets and P&L of these borrowers, of these corporate borrowers, right? And this is where the value add comes in, and we basically provide the services for that. Let me just try to get the video out. So the key takeaways for me is that AI can basically help banks do three things, right? You heard about customer acquisition, you heard about risk management, you talk about customer experience. But essentially, in a nutshell, AI can help banks find quality customers with the lowest cost at the lowest risk, okay, at the quickest time possible. So this is something that McKinsey, in fact, has in a different research estimated that the effects that AI can help banks and corporates is about $3 to $9 trillion, okay, worldwide across sectors. So types of AI that we were talking about earlier relates to natural language generation, NLG, and natural language processing, and turn them into a set of predictive and prescriptive analytics, right? And at the end of the day, we believe that banks, in order to improve their valuation, improve their efficiency, improve their customer engagement experience, and lowering their NPLs, AI can help them achieve all that, as seen in various multitude of case studies that have happened, not just to us, but also to many other practitioners of AI. So with that, thank you very much for your attention. I shall now bring over the discussion to the distinguished panelists to discuss about the banking landscape and how the impact of AI could impact them significantly. Shall we? Okay, can I have the general slide, please? Okay, so my question now, while we are collating the questions from the audience through the chat box, what we want to ask the panelists would be, these are as follows, right? Let me ask the three of them with these questions. So banks' considerations to grow organically or via acquisitions, right? Basically, for them to grow, they can either grow organically or via acquisitions. So what is happening now in Africa, and what are the banks facing right now? Are they going to grow more as usual, or are they changing the way of doing things, or are they being driven into M&A activities? What do you think is happening right now, gentlemen? Who would like to answer first? Perhaps Paulo or Charles?
Yes. Thank you, Nazri. Well, first, our group, we're quite pleased to have this opportunity under COVID to talk about these important issues and also building the bridge. Because I think your group and our group have been working to build a bridge between the Southeast Asia and Africa. And Southeast Asia is quite important. As you know, it's a $3 trillion GDP for the 10 countries. So it's a huge platform for growth, which is more or less the equivalent of what we are building in Africa with the Continental Free Trade Area. But I think on banking, it's definitely an important instrument for growth. Charles was talking earlier about the fact that there's been a consolidation. If you look at the market like Nigeria, they move from 85 banks in 2004 to now 25 banks. We're still the region with the biggest, profitability in terms of bank. Africa, if you look, our return on equity in Africa is in the region of 15% compared to a global return around 9%. So it's still the second most profitable banking platform in the world after Latin America. But we still have also a large number of unbanked. The number of bank people in Africa is now close to, it will hit in 2022, according to some of the report, something in the region of 450 million people, compared to 300 million in 2017. So we still have room for more bank people. People still prefer to go to their branch, the brick and mortar branch. I think another study showing that in East Africa, you have around 67% of people who still say that they want to go to their local branch. But the new generation is moving very quickly into digital type of banks. And you have in South Africa, a new bank called Team Bank, who has been building a kind of sizable platform of customers. So I think the brick and mortar will be in trouble in few years, and this is time now to continue to prepare, because the digitalization of Africa is going quite fast, and artificial intelligence is very important. And as you see, the objective of our group is to build a solid set of data. And we have that with the new African Capital Partner. We have been very focused in the last 2 years under Charles' leadership to build a huge amount of data, because at the end of the day, you need data to fill the IE system, and then you can extract whatever information you need from the customers in order to provide a custom-made service, which will make a difference in terms of having the ability to bring more customers. So I will flag those couple of issues, but I think my colleagues also will bring in some aspect for the banking sector in Africa.
How about your views, Charles, on this? Do you agree with what Paulo said? And do you think that right now M&A is a form of survival, or is it a form of growth strategy for these banks?
No, thank you. And again, thanks for giving us an opportunity to have this conversation. I think clearly from what we've seen in the past, there is a clear trend of a declining number of banks at the scale of the continent. And that has been driven essentially by regulations being tightened. And this, I believe, started with the last financial crisis. But more importantly, I think the business dynamics are also changing, and I can see 3 or 4 driving forces that are pushing for a new wave of consolidation. The first one is that there is clearly a convergence that is occurring between banks and telecom operators for financial inclusion. It's important to mention that at the scale of Africa, the telecom penetration, particularly in the mobile sector, has been completely changing the landscape when it comes to access to financial services. This is true that bank accounts are still quite low, and Paulo mentioned it. They're less than 40% of the population that has bank accounts. But notwithstanding that, in some areas in Africa, and particularly in Kenya and in West Africa, today we've seen instances where more than 60% of people are doing transactions over their phones, and that trend is actually moving across the continent quite heavily. So the first thing is the conversion that we're seeing between banks and telecoms will be driving to some fundamental changes into who will be the survivors into that. The second driving force is the competition that we're seeing from alternative players like fintech. We've seen a lot of startups and fintech doing great things when it comes to banking, payments, and even all the supporting apps for improvement of processes and so on and so forth. That in itself is pushing banks to significantly rethink at the way they are operating, and particularly moving away from brick and mortar, closing branches, and even redefining the type of partnership that they can build with those fintech. The third driving force is the quite high operating costs that we've seen in the past with most of the banks, particularly because there is an amounting pressure on interest margins. And the combination of reducing interest margins and high costs is actually completely pushing banks to now look for solutions, and this is where AI comes into play. Looking for solutions that will effectively reduce those costs, and in case that is not enough, building scale by merging with other entities. And obviously, and as I mentioned it earlier, regulations is pushing this. And the reason why regulation is pushing this is because most of the banks, I have to say, in Africa are still quite small in scale, either because the capital base are small, or because the market themselves are quite small. So the same way we saw in Nigeria, that consolidation happening in the early 2000s, we are seeing the same happening in most geographies now. Most recently, Ghana has gone into a phase of consolidation after the minimum capital base was increased. And it's quite likely that COVID is going to push further for that, because taking into account the fact that there is always a time lag between the occurrence of the crisis and the impact on the banks, we can foresee that in 2 or 3 years, the impact of the COVID on the bank's balance sheet is going to force another ways of consolidation, and therefore we should expect quite a few M&As occurring.
Thank you, Charles, for the insights on the dynamics that you just highlighted. And from a talent perspective, if all these dynamics are happening, Didier, do you think that the African banking professionals are able to withstand the onslaught of all these challenges, the dynamics that's been happening, right? Do you think they'll be impacted greater? Are they far behind the talent curve? Or do you think that a fair degree of reskilling, upskilling is needed for the banking professionals right now?
Bringing us into this conversation. Maybe before talking about the talent, let me bring another perspective into the banking conversation. And this will be the unbanked customers in Africa. According to the data, you have 350 million adults in Africa that are unbanked, don't have access to the financial system. So maybe you don't have enough banks in some countries. Maybe you have too many banks in some countries because, again, when you talk about South Africa, you talk about Morocco, Kenya, Togo, Cameroon, the situations are not probably the same. So my point to start this conversation is how to bank those unbanked people using innovation, artificial intelligence, and make sure we bank those people who basically earn revenue. Maybe they not earn revenue as high as some wealthy people, but probably when you look at the telco sector, how the telecom sector managed to grow heavily because of those people spending $1, $2, $3, $5, $10, $20 a week on airtime. You see how this sector has grown tremendously those 20 years. So my first comment will be how will the banking system in Africa address those challenges and bank the unbanked people? Now coming to the talent aspect of your question, probably two answers. The first one is that those last 15 years, we have seen some concentration and expansion plans from some of the banks. First, Nigerian banks who entered the Francophone markets, then the Moroccan bank who entered the African banking sector. So that tends to bring a couple of concentration when you talk about talent, meaning you have a few talent on the market moving around the banks to bring their experience and expertise to these banks. And on the recruitment side, we noticed that we couldn't afford the demand of the banks because you didn't have enough skills, enough qualified people to work in the banking sector. It doesn't mean people don't have the capacity to work in the banking sector, but it just means that they don't understand properly the market to be able to drive the growth the bank are expecting. Let me give an example. Talking about Kenya, have you seen how the banking market has evolved these years? Talking about the digitization of the markets, M-Pesa, mobile banking, etc. So those markets were far ahead. And while our market were trying to catch up, we didn't have enough skills to enter those new dynamics in the banking sector. So we don't have enough skills to address those new challenges that banks are facing. The second thing is that there is a lack of engineers, for instance. One of the major issues we're facing in Africa when you talk about talent is that we don't train people in all the technical fields. And when you talk about artificial intelligence, I assume you talk about technology. We talk about software engineers. We talk about people who can process, etc. So there's a lack of those kind of skills on the market. And if the markets, let's say, evolves into this direction, digitization, sophistication, artificial intelligence, we may not have enough skills. Probably the banking sector, we have to go look for those skills in the telco sector, where this telco sector has, of course, attracted a lot of talented people, especially in IT, software development, etc. So probably the banking sector will have to go again and pull out this talent from the telco sector. But again, we're not really fully ready to address the skills challenge in the banking sector if we take this trend.
Excellent sharing, Didier. And of course, wonderful sharing also by Paulo and Charles. There's a question by the audience who asked, we mentioned earlier that banking penetration is less than 40% on average. And how would AI be considered and might help increasing this number? by facilitating processes and reducing expansion costs as well as risks. So if there is a solution, whether it's AI or non-AI, right, how would such technology help to increase the banking penetration from 40% to say 50 or 80%? Any comments from the panelists on this?
Well, maybe I can bring the example of South Africa. You remember when we had the SME conference last year, and you were there, Nazri, and thank you again for your great presentation. And we brought in some fintech, and basically what they said is that through fintech, they managed to reach out to people who were unbanked before, but just because they used the telco data, they managed to get access to those customers and to give loans to those people who never get loan from the banking system, even though they were unbanked for some of them. And when you take two fintech that have attended the conference, they managed to lend more than $500 million to customers that they never met. You know, they didn't have any physical contact with those people, but basically through the digitization and artificial intelligence and mobile banking, they managed to reach out to those people that were, some of them unbanked or banked, but didn't have access to the credit system. So I think this can be an example that we can probably learn from, and that would be my answer to that question.
Thank you for that. How about
let me add to that and say that I think there is a general consensus that AI has a huge potential in changing the way banking will operate in the next few years in Africa. The numbers that we're seeing here and there are telling us that the next 100 million customers in the banking industry will be financially included. And what will support that financial inclusion is essentially AI. And why? First, because as Didier just mentioned it, the partnership and collaboration between banks and fintech is completely changing the way customer acquisition is now being done. And the second element is that banks themselves have now been clearly sensitized to the fact that if they don't change their internal model, i.e. if they don't digitize themselves, it's going to be extremely difficult for them to sustain in the long haul because the market is becoming extremely competitive. So I think it's clear now that AI is going to be a key element in uplifting the financial penetration. We're no longer talking about banking penetration. We're literally talking about financial penetration, because even having a bank account today can be done over a phone. So it's not about going into a bank to get this done. And the way some of the fintechs actually supporting that drive is actually quite tremendous.
Thank you, Charles. Paulo, anything from you they would like to add to the discussion?
Yeah, I think there's a huge effort that we need to deploy in the next 5 years, which is to make sure that we bring, as DSA, as many people into the banking, so to be more aggressive in terms of financial inclusion. And the good news is that you have a set of small financial entity in the microfinance world and mesofinance who are being also very proactive in getting new customers. Because the process of making our economy more and more formalized is very important in order to know who you need to target and how do you know how do you need to deploy some of the resources to help or to support people. We saw in this crisis that although we have a huge banking telecom penetration, we didn't manage to get instruments, very effective instruments, in order to help the most needy during this crisis. I was mentioning earlier in terms of some of the studies, projection that show that 70% of the growth in the retail industry will be on a segment of people who are making close to between $6,000 to $30,000 income per year. So we have to target that in terms of the banking and make sure that we extend some of the product and services to address them. And these are more likely the segment of people who will not go to the branch and could do the whole banking operation. So you have to capture them, providing a whole set of service, a subscription. You know, it's not just to serve them, as you mentioned earlier, in terms of their financial need. You have to kind of keep them with you by other type of subscription. So those could be a base of customers and tailor the service to them. So I think an effort has to be done. And I will also again emphasize the effort that we have been putting within our company, the New African Capital Partner, in managing data. We have a kind of a fair amount of data, because at the end of the day, artificial intelligence, you need to feed the system with data. And we have those data in many, from many places and many of our interaction, which I think would be very useful in terms of the machine learning to provide to you the information and the task that can be performed without human intelligence. And that would be important also, as Charles said, in terms of lowering our costs and being able to be more proactive and quick in providing service to our customers.
Thanks, guys. And speaking of data, there's another query from the audience that talked about, that asked a question about how AI will, as you rightly said, right, require data information. The question is, how is this information collected, processed, and incorporated for AI application? Perhaps at this point, I will just step in a little bit and to explain how, what are the smart ways and seamless ways for us to collect data. Data is everywhere. 80% of data is actually unstructured. Unstructured means text, unsegmented, it's all over, public and private, right? So unstructured data will be things like news, information, social media, publications, and interviews, so on and so forth. But when it comes to structured data, it's about 20% out there. Financial statements, bank statements, telco bills, utility bills, right? And as such, application forms. So naturally, these are the sources of data and the nature of data. So when you collect the 80% and the 20% of structured, unstructured and structured data respectively, what you need to do is to rely on various partners to share data while still respecting the law, the PDPA rules and, you know, GPDR rules and all that. But essentially, you can basically process data by relying on external public information as well as internal information. And based on those examples that I mentioned, when you, let's say you're a student going to apply for a loan, right? So you will certainly submit your education qualifications, or rather your application forms, right? Your bank forms, the telco bills, your home address. Probably we get to see your LinkedIn or your social media if you have one. Probably we look at your phone bills, right? Those things are basically sources of data that can be used to interpret your current social standing or social economic position and your ability and willingness to pay when the loan comes due. And this is where AI with its predictive analytics will be able to form a pattern, form an assessment of your ability and willingness to pay the loans as they come due. So the purpose of AI also has its purpose, whereby you basically want to know the risks, but you don't want to racially discriminate them or discriminate them based on their socio-economic profile. So we're talking about the underbanked now. So I would like to bring in the ethics portion, for example, whereby you cannot use AI to discriminate people based on their background. At the same time, you don't want to be exposed to high risk. So there is a very, very thin line that every bank must consider when you deal with the underbanked population, right? So do you discriminate them based on their nationality, their race, their where they live, the occupation that they have? So these are the things that are very much debated quite a bit. But at the same time, what you're after, does it mean that rich people will never get into default problems? Does it mean that poor people will never be able to pay their loans as they come due? Not really, right? So you can see that a lot of all the collapse, of businesses these days come from big boys, right? Big corporations. So because of that, we have to have a very balanced. The AI needs to be trained how to look at things in a non-discriminatory way. So let's say we have that sorted out, right? The next question then becomes, how do you quickly speed up the decisioning? How do you make sure they get to use the money for good? And then make sure how to get the money back once they use the money to good use, right? So these are all the components that are free from any form of discriminatory factors, but focus on purely on the ability and willingness, right? By looking at patterns of transactions, by looking at the, the granularity of the situation that they're facing, and what affordability they can give when they pay their loans to the banks. So these are the things that how I would say positive factors, right? Feel good factors that can be realistically applied in a lending borrowing setting. All right. So I hope this gives some perspective to the person who asked the question. Okay. Anything to add about information, gentlemen, before we move on?
Well, I think it's important that to underline these two aspects that you raised. The first one is to make sure that the models are not biased, and that's important for trust with the customer. And the secondly is that would be very important for the regulator, in what extent the model, the system can help you detect suspicious behavior in some of the transactions, which I think will be also important in building trust and capability within the banks.
Maybe I can just add on top of that what Paulo just said is right. The thing is that how do you consolidate data that are available? Because everybody works in silo, especially in Africa. From the COVID, for instance, government were willing to provide financial support to the population, and they were unable to track people, for instance, who were working in the informal sector. Suddenly, those guys moved from the city to the villages, so they were unable to identify them, to provide them the grant that those people were needing. So how do you make sure you bring together data from the telco industry, data maybe from the welfare system, data from the university system, and put this together and make sure artificial intelligence manage to categorize and put people in each category where governments can have plans for each category, because that is lack of data that justifies sometimes the fact that government say they cannot reach out to people, they cannot support people, they cannot have social programs, and this is a serious issue. So even without the banking system, how do we make sure our government manage to identify its population and develop social programs for those people?
Thank you, Didier. My next question is very much centered around what NACP does, right? And can the adoption of best practices, right, in terms of governance systems and managing loan books impact the valuation of a bank? You guys have been involved in a lot of negotiations and helping banks larger banks to acquire smaller banks and so on and so forth, right? So would these three factors, as I mentioned, right, governance, systems, and loan books impact the valuation of a bank when it comes to bringing a larger and a smaller bank together? And to what extent would that impact the valuation of a bank? This question extends to the three of you. Thank you.
Charles.
Paulo, you want to start? You want to start, or should I start?
Yeah, you can start, Charles.
Okay, no, thank you. No, I believe, again, as you probably know, I mean, typically when it comes to valuation of banks, one of the key things we're looking at least in terms of financial terms, is to look at the ability for the bank, on the one hand, to have a return on capital that is much higher than the average cost of capital that we put in, and more importantly, to ensure that the stream of dividend that we can generate from this operation can be sustained in order to ensure that effectively the company grows steadily over time. But all of this cannot and may not happen if there is not a strong enough governance structure behind it. And maybe what I'm saying here is a little bit aggressive, but I believe probably in Africa more than any other place, the importance of governance will not be overemphasized. And for a very simple reason, perception matters. And because there's been a perception that risks in Africa are much higher for whatever good or bad reason, it's important to address some of these risks by ensuring that the framework within which decisions are made, the framework within which controls are implemented, the framework within which strategic oversight on the business are being implemented. Such framework is very strong and ensures that there is consistency and reliability into that, because that's the price that we have to pay to ensure that trust is at the forefront of everything that we do. So governance is very important. Obviously, systems and technology is a critical success factor in this industry, in financial services. Again, not to go into too many details, but if you look at any banks or any financial service, there are typically 6 key success factors: capital, technology, talents, controls, innovation, and culture. So technology is part of it, and therefore systems are part of it. So we have to ensure that the systems that we build are strong enough to ensure that the outcome and the controls that we have can sustain and preserve and safeguard the assets that we have. And obviously one of the key assets in that is the loan book. So not to dwell too much, these 3 items that you mentioned, governance, systems, technology, and loan book, are critical in any form of valuation of banks and financial services. And these are typically some of the things that we, as an institution, in any transaction that we do beyond the numbers, look into in order to make a decision. Thank you.
Excellent answer, Charles. We've got a last question from the audience before we recap the key discussion points here, from Mohammed Iqbal. So he talks about how different African regions have different needs and different responses, right, to transformation and digitalization issues, right? However, he said that the main issue is the level of capital. I think this is a conversation that Paulo, Didier, and I had when they were in Singapore, talking about the latest ruling of the minimum capital requirements, and then the inadequacy of capital by many banks, which limits their ability to expand or to act in the respective markets. So with such limitations of capital or the increased required capital for banks, how do you think that the African banks should do to survive? What do you think they should do to survive? And what are the options, as well as what is a likely impact if they don't do what they're supposed to do? Open to the three of you.
Yes, I think Charles have emphasized the issue of governance, which is very important. The regulators have been very, very very tough, I think, with the banking sector and looking at all the issues related to the regulation. In terms of capital, it wasn't so bad. If you look at the statistics, there was enough liquidity and capital for many banks to face any as a caution. But this was obviously before the COVID. With the COVID and with most of the consequences probably will start showing up, as Charles said, in the next 2 years, there may be a challenge. In terms of perceptions, the people still believe that the bigger the bank, the best it is. There's a perception of people to say, it has to be a big bank. That trust comes with the fact that the bank is big. Whether or not, I mean, the return will be very high on those big banks, but people still want that big banks to exist. But there will be a change in the perception, in the mindset. I think it will be also related with the age of the population. So you will see probably people having more trust if the governance is robust in terms of going to some small financial institution where have digitalized as much their operation. And that's linked also with the level of investment in IT in many of our countries. As you know, the gap we have in terms of funding for fiber optics and all upgrading our digital platforms is close to $20 to $30 billion in Africa. And of course, there will be a need for resources for that. But again, as I mentioned initially, Africa has the second highest return on equity after Latin America, in the region of 15 to 19%, compared to the global 9%. So it's still a continent where you have to invest if you want a high return in terms of the financial services and banking. Also, the number of people that are in the informal sector and are unbanked, it's a huge opportunity. You shouldn't see that as a problem. On the contrary, bringing those people into the formal sector and bringing them to have an account is a huge opportunity for the banking sector. So we're quite optimistic on that. And the bridge we are trying to build with Southeast Asia is precisely by using a lot of your best practice and opportunity that you have managed to deploy in Southeast Asia. Singapore, Malaysia, Indonesia is certainly where we look at in order to also build and customize to our reality in Africa. That's opportunity for growth.
Thank you.
To add on to that quickly, if I may, in just a few seconds, because I wrote an article recently on that subject matter, and the outcome of that was quite simple. One is, it's true that there are still too many small banks at the scale of the continent, not highly capitalized, which is one of the reasons why the total loan book of banks in Africa as a percentage of the GDP is still below 30%, okay? And if you compare that to most of the other regions, in Europe, it's more than 100%. In Asia, it's almost the same, and so on and so forth. One of the reasons why this is the case is because I believe there is a need to increase that capital base. In countries where this has been done, it has triggered some consolidation. And one of our roles as NACP, and one of the reasons why we were created, was precisely to raise funds to support the growth of the capital base of our target banks and our target financial institution. Because the only way we can ensure that the banks are in a position to effectively support the real economy is when they have strong, reliable, and permanent capital that can effectively achieve that. So the response is beyond being regulatory, when regulators impose a new capital requirement, is for us as investors to effectively identify those banks that we believe have the right business model and that we believe have the right potential for penetration and provide them with the capital that they need. That's why we're fundraising, and that's why we are investing in some of the banks at the scale of the continent.
Thank you, gentlemen. Just a quick comment from Didier, right? You've seen about heightened regulatory capital. Is there any correlation between the statutory capital required by regulators and the human capital growth, or activities that you see across the African banking sector? Is that correlation that we can make out of the state of capital in banks vis-a-vis the human capital requirements of the banks?
Oh, yes, definitely. If banks cannot grow, they cannot recruit, basically. And the cost of capital for me is too high in Africa. And Charles mentioned it, perception of risk is too high. So as long as banks cannot afford to grow because they have access to affordable capital, they won't grow fast enough. The second thing is that to come back to regulation, I think in some countries, especially in Francophone countries, West Africa, regulation is very restrictive. Like talking about digital banking. You compare Senegal to Kenya, for instance, it's a whole world because regulation is still quite restrictive to allow banks or other institutions to tap into these potential markets. And the fact that, Basel II and 3 rules have been also implemented so quickly, it didn't allow, some banks to have enough flexibility to adjust, to adapt the strategy. The third thing is that if you look at some of the banks, the level of liquidity is quite high in some of those banks. But again, when you look at the SMEs, for instance, that are affixed to loans, the figures are really small. Less than 20% of SME financing comes from the financial institution. So my point is, if you manage to have access to low capital, to allow bank to grow faster, to a little bit lower the level of regulation for some banks to enter the digital markets, we may have tremendous growth of the banks in Africa, and then offer more jobs for African talents. And again, big is not necessarily the answer. I think Paulo or Charles mentioned it. Being big is not necessarily the answer. So how do we make sure we have flexible banks that can address specific markets, specific market size, and not necessarily big banks like in the old days? That would be my comment, Nazri.
Thank you very much. All right, ladies and gentlemen, we've reached the end of our 1 hour-ish webinar. Certainly, this is one of the few episodes that we are putting together with NACP, and the focus of today's discussion, as always, is always about the dynamics of the banking sector, with real case sharing by the distinguished panelists, and how AI actually plays in the middle of it. AI is a means to an end, right? So how it's being used as an enabler, as a driver across the different banking functions, whether it's the underbank, whether it's the SME, whether it's the individuals or the corporates. AI plays an important part as far as customer service, client acquisition, risk management, business engineering, as well as generating new leads as a form of growth. So thank you so much, gentlemen, for the insightful sharing. We actually have subsequent episodes that come after this in the following weeks. Can we have a look at what are the other episodes that are coming on board? Do you have any poster on that, Miza? Thank you. I think the second episode is about SME lending, right? And specifically on the strategies on how to use AI in SME lending activities, which is happening next week, right? And how about episode 3 and 4 and 5?
I think episode 3 or 4, it's about merger and acquisition, and 5 is about talents. Yes, okay.
Yeah, thank you so much. Yeah, I just want to get the title right. And basically, it's about SME learning in COVID era for episode 2. Moving on to episode 3. It's about M&A, right, Didier?
Yes, yes. Whether 3 or 4 is about M&A.
And episode 5 is about human capital.
Yes, the last one is about human capital, indeed.
So do join us in the subsequent weeks, and we'll be happy to have the resident speakers from NACP, who is highly experienced bankers and advisors to many, many banks. They carried out many mergers and acquisition activities right now as we speak. And you can distill a lot of knowledge and information from them as best as they can reveal. They will do that for sure. And certainly they will not selfish to share their knowledge in this field. As far as on my side is concerned, we are very encouraged to see the level of AI adoption across many institutions that includes banks. And we, together with NACP, have partnered together to introduce AI into the African markets, in particular through the African banking sector first. So with that, thank you very much. Thank you, panelists. Really appreciate your time. And thank you, the audience, for especially the Asian audience that stayed through the night to hear us. Thank you, and have a good evening or day, wherever you are. Thank you.
Thank you, Nazri. Thank you.